Right now, on your social media feed, there's probably a 22-year-old on a yacht.
Oh, almost certainly.
Right, and he's claiming he made like a 300% return this month using some secret trading indicator.
Which is, just a wild thing to claim.
It really is. But what if I told you that in the actual professional world, the absolute best, most highly skilled fund managers on earth consider a 15% annual return to be an absolute triumph?
The total victory, yeah.
So, welcome to this custom tailored deep dive. Whether you're actively managing your own investments or exploring the financial world for the first time, or you just love breaking down complex systems, you are in the right place.
Exactly. And today we are analyzing this phenomenal piece of research. It was published in April 2026 by Quantpedia.
Yeah, written by quant analyst David Mezicek, it's titled Trading as a Small Business, What Beginner Investors and Traders Usually Learn Too Late.
It's such a good piece. And our mission for this deep dive is to basically systematically dismantle that social media fantasy. The idea of trading as a quick, secret shortcut to wealth.
Right, and then rebuild it from the ground up using a realistic professional framework. By the time we finish this conversation, the way you view risk, reward, and your own competitive advantage is going to fundamentally change.
I completely agree. It's a total paradigm shift.
Okay, let's unpack this, because before we can build a solid trading business, we first have to take a sledgehammer to the illusion of what trading actually looks like.
We really do. The online perception is just so skewed.
It is. When you scroll online, the trading world looks like this environment where if you just study hard enough and find the right chart pattern, you'll get huge returns with almost zero risk.
Right, which is just mathematically impossible over the long run.
Exactly. It feels exactly like the fitness influencer industry. You only see the perfectly lit highlight reel, the flex.
Just the after photo.
Right. You never see the 5 a.m. grind in the freezing cold, the brutally restrictive diet, or the pulled muscles that put them out of commission for months.
And the financial equivalent of those pulled muscles is a catastrophic drawdown. The data really backs up just how harsh that reality is.
Yeah, because the real numbers are sobering.
They are. Over long time horizons, we're talking decades, the track records of highly skilled professional traders tend to converge toward a return-to-risk ratio of approximately 1-to-1.
Right, so just a 1-to-1 ratio.
Yeah, 1-to-1. In practical terms, that means if your strategy generates an average annual return of 15%, you have to be prepared to endure a maximum drawdown of roughly 15% as well.
Wow. So to make 15% a year, you basically have to stomach watching 15% of your money just vanish along the way.
Exactly. From your account's peak value.
That completely shatters the internet illusion of making triple digits without ever breaking a sweat. It actually brings to mind Mabane Faber's research on the Sharpe ratio.
Oh, yeah, that's a perfect connection.
Right, which is a standard metric for risk-adjusted returns. For anyone unfamiliar, think of the Sharpe ratio like looking at a race car's average speed, but also factoring in how many times it almost swerved off a cliff to get there.
That is a great way to put it.
Thanks. Because if you make 20% but risk losing 50% of your account to pull it off, your Sharpe ratio is terrible. And Faber's research shows that consistently achieving exceptional risk-adjusted performance is incredibly rare in real markets.
It really is. Getting high returns without the terrifying roller coaster drops is just, it's not the norm. When you do see those abnormally high double-digit returns with very small drawdowns advertised online, it's almost always a fluke.
Like just being in the right place at the right time.
Exactly. It's usually the result of a temporary, favorable market regime rather than a repeatable skill. The trader strategy just happened to accidentally align perfectly with the prevailing macroeconomic winds.
And when the wind changes, those returns evaporate.
Just poof,
Wow.
gone. If we connect this to the bigger picture, these unrealistic expectations are incredibly dangerous.
Because they set you up for failure from day one.
Exactly. They aren't just harmless fantasies. They represent a deeply flawed mental model that poisons a beginner's decision-making. You start taking massive, uncalculated risks because you mistakenly believe that zero drawdown, triple-digit returns are like the normal baseline of success.
Right. And when you inevitably fail to hit those impossible returns, you run face first into the drops.
Which is going to happen.
Always. Those modest, realistic returns we just talked about always come with a corresponding decline in capital. which forces us to look at the psychological reality of risk.
Because a drawdown isn't just a red number on a spreadsheet.
Exactly. It is visceral. I feel like almost everyone dramatically overestimates their risk tolerance, especially during a roaring bull market.
Oh, 100%. When every stock is going up and a market pullback lasts maybe 3 days, a beginner will look at a back test and say, oh, sure, I can handle a 30% or even 50% drop if the long-term payout is big enough.
Right, because in your head, a 50% drop is just a math problem you wait out. You tell yourself, I'll just hold the line. It'll be fine.
But living through it is a completely different universe. A prolonged drawdown destroys your sleep. It shatters your confidence.
I can only imagine. It's got to be incredibly stressful.
It is. A mathematically sound, perfectly robust strategy can feel broken when you're 6 months into losing money. Your decision quality plummets because you're no longer executing a plan. You're operating out of pure fear.
And there is a massive structural difference here between institutional capital and retail capital, isn't there?
Oh, massive. When a professional fund manager is trading institutional capital, it's highly abstract. They operate with defined constraints, a risk department watching over them, and, career incentives.
Plus, they still get paid.
Exactly. Most importantly, they still collect a 6-figure salary while the fund is down. But for the retail trader, the person listening to us right now, that capital is deeply personal.
It's their actual savings. It's the down payment for a house or their kid's college fund.
Right. It's real life.
The psychological pressure is crushingly heavy because that account isn't an abstract concept, it's their future. And it doesn't just bounce back instantly either. When you look at the mechanics of recovery, a deep drawdown could easily last 18 to 36 months.
Think about the day-to-day reality of that. 3 entire years where your account is underwater, slowly trying to crawl back to the break-even point.
That sounds agonizing.
For an active trader who relies on those profits, that feels exactly like being unemployed for 3 years. Every day you wake up, you do the grueling analytical work, and you make zero net progress.
Wow.
This raises an important question. If the psychological pain is that intense, and small traders don't have those institutional safety nets or fixed salaries, why do they subject themselves to this using massive leverage and wild strategies?
Well, let me push back on that framework a bit. If the emotional weight of losing personal capital is that heavy, and the big institutions have the safety nets, the risk departments, and the supercomputers, shouldn't a retail trader just try to reverse engineer and copy the exact strategies of massive hedge funds?
That's what a lot of people think, yeah.
I mean, mimicking the big guys seems like the safest way to survive, right?
It's a very logical assumption, but copying institutional funds is actually the biggest structural mistake a small trader can make.
Really? The biggest mistake?
Yeah, because it demonstrates a total misunderstanding of market mechanics. You see, a retail trader's small size isn't a weakness. It is actually their greatest hidden advantage.
Here's where it gets really interesting, because the way I'm picturing this, a small retail trader is like a nimble little speedboat.
Okay, I like that visual.
Right. You can weave through shallow, narrow channels, darting into these tiny, hidden coves to find treasure. But the institutional funds are massive, bloated cargo ships.
Yeah, exactly.
They couldn't go into that shallow cove even if they knew the treasure was there. They're stuck navigating the crowded, deep-water main shipping lanes, fighting with all the other massive ships for the exact same cargo.
That analogy perfectly captures the mechanics of liquidity. Large funds, the institutional cargo ships, are forced to deploy billions of dollars.
Which is a good problem to have, but still a problem.
Right. Because of that massive size, they're physically trapped. They can only trade in highly liquid markets, like major currencies or massive large-cap tech stocks, where they can actually buy and sell millions of shares without accidentally causing the market price to crash against them.
So they are stuck in the deep water.
Completely. And because every major player is forced into those exact same highly liquid markets, those arenas are hyper-competitive and incredibly efficient. Every drop of edge has been squeezed out by algorithms.
But retail traders don't have billions to deploy.
Nope. They can slip into niche markets that are simply too small or too inconvenient for the big institutional players to even bother with.
And the Quantpedia research gives us brilliant, concrete examples of these hidden coves. One study they highlight focuses on soccer clubs' stocks arbitrage.
Yeah, European football clubs that are publicly traded.
Exactly. I mean, a massive hedge fund cannot deploy $1 billion into the stock of a single European soccer club without literally buying the whole team, triggering SEC filings and causing regulatory chaos.
Exactly. The cargo ship cannot enter that harbor.
Yeah.
But why do pricing inefficiencies exist there in the first place? Because the market cap is tiny, and the stock is often driven by the extreme emotional sentiment of the fan base, rather than financial fundamentals.
So if a team wins a big match, emotional fans might flood in and overvalue the stock.
Right, and a small trader can absolutely exploit those little pricing anomalies, shorting the emotional spike, because they can enter and exit quietly.
Without moving the market. Another example the research mentions is evaluating reversal potential in niche alternative ETFs.
Which is another classic speedboat move.
So we're talking about an exchange-traded fund with very low popularity, limited liquidity, and almost zero coverage by Wall Street analysts.
Yeah, the stuff no one is paying attention to.
I imagine reversals happen there because of liquidity vacuums. If a medium-sized player suddenly needs to sell their position in an obscure ETF, there simply aren't enough buyers waiting.
Right, there's no depth.
So the price plummets artificially low, not because the underlying assets are failing, but just because of a temporary lack of buyers. The nimble retail trader sees that massive discount, scoops it up, and waits for the price to normalize.
That is the speedboat advantage in action. So now that we understand small traders have this unique agility, how do they actually apply it without flipping the boat over?
That's the real trick.
It is. The core argument here is that you must treat your trading exactly like a small startup business.
Which requires a profound shift in mindset. Let's contrast active trading with passive investing for a second.
Okay, let's do it.
If you want market exposure without the heavy lifting, you buy a broad index fund. You are essentially buying a microscopic piece of an existing, functioning, profitable business.
Right. It's already running.
But active trading hunting for edge and trying to beat the market is not buying an existing business. It is the equivalent of starting a brand new business from scratch. Beginners often want all the rewards of entrepreneurship without the agonizing grind of building something real.
They want the wealth and freedom on day one.
Exactly. It's like a first-time entrepreneur trying to open and manage 20 Starbucks locations on day one, rather than taking the time to learn how to properly run a single small local cafe.
And to run that local cafe successfully, you need immense structure. You have to treat your trading capital like actual business capital.
Because if a physical cafe runs out of cash to buy coffee beans, the business dies.
Exactly. In trading, if you lose your core capital, you cannot participate in the market. You must protect it to survive long enough for experience and compounding to actually take effect.
And just like a new local cafe, you probably shouldn't expect to be pulling in millions of dollars in month one, right? Which means you have to keep your revenue expectations grounded.
You really do.
You shouldn't try to fund your lifestyle or quit your day job based on early, unstable wins in the market.
Precisely. You also have to specialize. A beginner doesn't need to trade every asset class on Earth, just like a new cafe doesn't need to sell sushi and hardware supplies.
Sushi and hardware, that would be a terrible cafe.
It would be a disaster. Your edge comes from mastering one specific environment, one execution style, or one niche.
You master the local cafe first, and before you even think about opening a second location, a real business owner understands their stress points. They implement risk controls before attempting aggressive growth.
Which beginners almost never do.
Right. A trader must know their absolute maximum risk limits before they start maxing out the size of their trades. And tying all of this together is the least glamorous requirement of all patience.
Patience is huge. Trading edges are incredibly noisy, and they take time to validate. The market won't give you instant feedback that your business model is working.
It's not like a video game where you level up immediately.
Exactly. The primary goal at the beginning isn't maximizing your growth or getting an adrenaline rush. The primary goal is simple survival. You are just trying to build a repeatable working process that doesn't blow up.
But if we agree that building slowly is the right path, we have to acknowledge human nature.
Oh, sure.
We get impatient. It is so tempting to look for technological shortcuts to speed up the grind. I mean, people think if I just use a more complex algorithm or throw artificial intelligence at my charts, I can skip the line, right?
It's a very common trap.
But the research explicitly warns that in trading, complexity is very often a mirage.
Beginners naturally assume that more advanced, mathematically complicated methods must yield superior results. But unless a trader is utilizing massive, difficult-to-process alternative data sets, adding complex machine learning to standard price charts adds very little value.
Let's clarify that. When we say alternative data sets, we mean things like analyzing satellite imagery of retail parking lots to predict quarterly earnings, right?
Right, or parsing the unstructured text of millions of global shipping manifests and patent filings. If you were just looking at the daily closing price of a standard stock, throwing a neural network at it isn't going to magically print money. It often just adds fragility.
This brings us to a very specific, very modern danger. The source highlights large language models, or LLMs, in trading.
This is a huge issue right now.
Everyone right now wants to feed data into a chatbot and have it pick their stocks. And the terrifying part is, when you test these models on past data, the results look like sheer genius.
What's fascinating here is the psychology behind why we fall for it. We're easily seduced by complex tools because they make us feel sophisticated.
We want to feel like we have the secret weapon.
Exactly. But when an LLM looks amazing in a backtest, you have to understand the underlying mechanism. An LLM is trained on vast amounts of historical data. When you test it on past market events, there is a massive risk that the AI is simply memorizing the historical data rather than demonstrating true predictive skill.
Wow, so it already knows the answer.
Exactly. It's like taking a history test when you've already memorized the answer key.
Yeah.
You look like a genius, but you haven't actually learned how to predict the future.
Which is why out-of-sample and walk-forward validation are absolute necessities. You have to test the model on data it has never, ever seen before in live or paper trading conditions over a meaningful amount of time.
You have to see if it actually understands the mechanics of the market or if it's just reciting history.
So I have a rhetorical question for you listening right now. Are you chasing a complicated strategy just because it looks smart on a spreadsheet, or do you actually understand the mechanics of why it works?
That is the core issue.
Because if you don't deeply understand the why, a complex model becomes incredibly difficult to trust. The second you enter a 30% drawdown, you're going to panic, assume the AI is broken, and pull the plug.
And lock in those lasses.
Right. A simpler, more robust model that you deeply understand is infinitely easier to stick with during those brutal periods.
And that psychological resilience, the ability to stick with a strategy during the dark periods, is what actually separates the professionals from the amateurs.
So if complex AI models aren't the magic bullet for survival, what is the unglamorous foundation that actually keeps this business alive when the market turns hostile?
Well, according to the research, the ultimate dividing line is risk management.
Not high returns.
Nope. Amateurs start their journey looking for high returns. Professionals start their journey looking at risk management. Survival always precedes performance.
That makes total sense. And you manage that risk practically through diversification. But not just the traditional advice of buying different stocks, right?
Exactly. Professionals diversify across entirely different strategies. The Quantpedia research highlights combining things like calendar strategies into a trading portfolio.
Okay, let's break down the mechanics of a calendar strategy. Because this isn't just astrology for stocks. There are actual mechanical reasons why markets behave differently at different times of the year, right?
Absolutely. A calendar strategy exploits predictable systemic capital flows.
Like what?
For example, tax loss harvesting in December. Institutional funds will often sell off losing positions at the end of the year to offset their capital gains taxes. This creates massive artificial downward pressure on certain stocks.
So they're selling just for tax reasons, not because the company is failing.
Right. But come January, that selling pressure vanishes, and those same stocks often experience a rebound effect.
Yeah.
Or consider agricultural cycles, or the predictable influx of capital into the market around bi-weekly corporate paydays when retirement contributions hit.
Oh, that makes sense. Regular cash inflows.
Exactly. You combine these structural time-based strategies with trend-following strategies, so your overall trading business isn't reliant on just one weather pattern.
And the research also emphasizes the necessity of crisis hedge strategies. If diversification is about having different revenue streams, hedging is about buying insurance for the cafe.
That's a perfect way to look at it.
A crisis hedge strategy is specifically engineered to go up when traditional assets violently decline. You might achieve this by systematically buying out-of-the-money put options or utilizing volatility products that spike during a panic.
And the goal of a hedge isn't to perfectly eliminate all your losses, because insurance costs money.
Right, you pay a premium.
Exactly. The goal is to act as a shock absorber. When the market crashes, your hedge softens the blow, protecting your core capital so your business lives to trade another day.
So what does this all mean? It means that a durable trading strategy isn't about being mesmerized by the flashiest tools or the highest backtested numbers. It is entirely about building a structure that can survive violent contact with harsh reality.
It's about surviving the bad days, not just celebrating the good ones.
We've covered a tremendous amount of ground today. We started by shedding that toxic, social media-fueled fantasy of triple-digit gains and perfectly smooth paths to wealth.
We really faced the agonizing psychological reality of drawdowns, too, and how managing your own hard-earned savings feels radically different than managing a massive corporate fund.
We then discovered that being a small player is not a curse. By maneuvering like a nimble speedboat into niche, inefficient markets like tiny European football clubs or illiquid alternative ETFs, you possess a distinct structural advantage.
An advantage that billion-dollar cargo ships simply cannot replicate due to their sheer size.
And to extract that advantage, you have to adopt the mindset of a small business owner, protecting your capital at all costs, setting realistic revenue goals, mastering one specific niche, putting risk controls ahead of growth, and practicing extreme, unwavering patience.
Because true knowledge isn't just about memorizing new financial terms. It's about fundamentally shifting the framework of how you approach complex problems.
And a shift in framework is the most valuable asset you can acquire. To you listening, we hope this deep dive hasn't just given you trading mechanics, but a totally new lens through which to view risk and reward.
Absolutely.
So as we wrap up our session today, I want to leave you with a question to chew on, something to carry with you. Think about your current approach to learning a new skill or even managing your own finances. Are you trying to franchise 20 Starbucks locations overnight, or are you taking the quiet, unglamorous time to perfect that very first cup of coffee?
It's all about that first cup.
Furthermore, look at your own life. What is the one niche where your small size, your agility, and your unique perspective give you a competitive advantage that the big players couldn't possibly replicate?
That is a phenomenal question to ponder. It's been a privilege exploring these mechanics with you today.
Thanks for joining us for this deep dive. We'll catch you next time.